I think you want the Nina back, the Sisa, and the Noni, everything, right?
The Santa Maria. What were they again? The Nina, the Pinta, and the Santa Maria. Yeah, let's get a couple of those loans going.
Wow. Sail off into your sunset, Bryan.
It kind of makes you chuckle because you can tell when people get into our business in like the early 2000s. Yeah. Because they went 5 or 6 years without actually collecting a tax return. They were just so used to that type of loan. Back in the day.
Well, listen, I think you've got loan originators in the business today that still remember that time, that don't want to accept that it's a different time, right? And they still have a hard time. Like, they're afraid that if they go to a borrower and ask for some bank statements, some tax returns, and some W-2s, they're going to be like, nope, I'm out. We're not getting that loan.
I don't want it.
Somebody else is going to give me that loan and not going to ask for all that stuff. All right, welcome to another episode of the Contacts to Contracts podcast. I am Bryan Lovell, always here with Mr. John Jones as our amazing co-host. And we have a special guest with us today. Joining us from Angel Oak Mortgage Solutions is Stacy Flanigan. So Stacy, welcome to the show. Thanks for being here with John and I today.
Thanks for having me. I appreciate it.
Nice to see you in person. It's been a little bit over a year, right?
It's been a while, yeah.
It's been a while out and about.
Yep. It feels good to be out and about.
It does feel good to be out and about. That's what we keep talking about.
Yeah.
Getting back to some normalcy.
And not teaching elementary school.
Oh, that was brutal. That was so brutal.
So far I haven't met anybody.
She was clearly smarter than you and I because she jumped out right away. Her kids went back right in September, August, September. Yeah. I waited the first quarter through.
I waited the first semester.
Yeah, you went half a year through Christmas.
I haven't met anybody yet who was homeschooling their kids that was like, man, I loved it. It was awesome.
I haven't either.
No.
It's not out there.
No, it was tough.
I have a new appreciation.
If you're out there, send us a message. yes. We're curious.
I totally
How'd you do it?
I totally have a new appreciation for teachers.
Absolutely.
Just, being mean. I've always been like, well, you guys only really work part-time. You get the whole summer off. They freaking need it.
They deserve the whole summer off.
No wonder.
And they deserve a raise.
They do. They for sure do. So
big time.
So to all the teachers out there, thank you for taking care of our kids so that we can actually have some fun.
So we can do our easier job.
Right.
So cool.
Much easier.
Yeah.
So Stacy, tell us a little bit, how long you been in the mortgage business? Like, what was your journey like?
I started back with Alliance Funding in 1998 as a rep for what we used to call subprime.
Okay.
So I've been doing repping for non-QM, as we now refer to it as, since then. So I love it. I absolutely love the wholesale side. I love being a rep. When subprime went out of business back in 2008, the crash, I didn't want to do anything else. I had a bunch of calls from agency lenders saying, come over to the agency side. And I'm like, no, I like fitting the square peg into the round hole and figuring out and manipulating and massaging loans and trying to make them fit into our programs. So I was so excited when Angel Oak came back into business. And
wow.
Yeah.
Wow. What did you do after the subprime crash?
So I actually became a sales manager at Tradewinds.
Okay.
So I was doing group sales, trying to get people like Van Dyke to host their
conferences there.
Yeah. So I did that for 2 years, and then had a baby and stayed home for 2 years. And then Angel Oak called right when he was 2 years old and said, "You're coming back.
We would like you to come back to work now, please."
Yep.
Yeah. So you've been back, about 6-7 years, is it?
Yeah. I've been with Angel Oak almost 7 years now.
Okay.
Yeah. I joke all the time about people in the mortgage business, especially those that are like just getting in, like they're the rookies or whatever.
Hotel California.
This is like John's heard this before. This is like a Hotel California. Like you can check out anytime you like. You just can't ever leave.
Exactly.
So you checked out for a little bit.
I did. I checked out. Couldn't wait for it to come back.
So cool. So tell us a little bit about Angel Oak. What are you guys specializing in?
We're a non-QM lender. We do portfolio loans. So you have your one-stop shop with Van Dyke now because we're partnered, obviously, in a great relationship. So you have your QM, conventional, FHA, VA, all those type loans. And now with our partnership that we have with you guys, you can now offer our loans, which is going to be your bank statement programs for self-employed borrowers. It's going to be your no income cash flow loans, which a lot of people know as the DSCR, debt service coverage loans. So anything that you can't get done on the conventional side, you have that ability to portfolio those loans with us on the non-QM side.
All right, cool.
So what has changed going back, prior to 2008? It was subprime. There were some different loans out there that we kind of got away from us, right? And created this market collapse. What's different and what's new about it that we do now that's different from that day?
So then it was definitely a lot more lenient.
Like stated
W-2, liar's loans, we used to call them.
Right.
But now there's a lot more regulations. You have Dodd-Frank, you have the CFPB. We're very concerned with ability to repay. All of our loans we require to be able to see the ability to repay, whether it's through reserves, whether it's through residual income. So we're a lot more conservative. We're definitely looking at each loan on the borrower themselves credit score, but yes, we are still offering the bank statement program for the self-employed borrowers, but we're a lot more regulated now. We want to see
you're seeing the income stream.
We're seeing the income stream. We're using an expense ratio. Again, we have the disposable income or residual income that we look at, where before we didn't do any of that.
Right.
We didn't have anything. There wasn't a CFPB. There was no regulation.
Right.
It was
whatever
just
write it down on your
application,
your 1003, put the income down, and that was the end of it. You wouldn't have to gather up 12 months, 24 months bank statements.
Yeah. So I mean, to some degree, you're doing like financial forensics.
Yes.
Right. To underwrite a loan is like, hey, here's you may not be using a W-2 or a tax return, but you're using some sort of financial information to try to engineer what income could actually come out of this to make a deal work.
Right. So then what we used to call subprime, the subprime borrowers never went away. The subprime lenders went away because we didn't have those regulations. So now that we came back into the playing field about 6-7 years ago, non-QM started to come back. Those borrowers were always still out there. And a lot of them, they deserve a home. If you're self-employed, you're going to write off everything that you can.
Yeah.
I would. So these people are still deserving to get into their dream home. So offering that and being able to offer that and let them get into their dream home, it's pretty satisfying.
Yeah. Just curious, I know I'm probably getting off topic here, but as you were saying that, it made me think, like, what is like the delinquency rate on some of these? Like, are these well-performing loans?
Yes. So anything that isn't well-performing, we would hear about it. If our delinquency rate was high, we would hear about it through our upper management. They would be tightening up, and they're not. So every other week, we have a conference call on Fridays, and they don't really go into how our loans are performing, but they are definitely loosening guidelines every time we have a conference call, whether it's lowering FICO scores or raising loan to values, or reducing rates. We've been reducing rates consistently since we came back after COVID. So if there was a high delinquency, these enhancements wouldn't be going on.
Right. Yeah. So I mean, you just laid out, here are the risk factors associated with a loan. So from your perspective as a company, if the loans are performing, that means they're less riskier. So let's reduce some of the risk factors. And a lot of people don't realize that rate is one of the things that lenders will do to
increase or decrease, right?
Align with the risk
Loan
factors
flow.
associated with those loans. So that's great. That's great news to hear.
Yep, absolutely.
That's great news to hear, because I think that there was a period of time in this business, in that subprime that you were in, that the loans weren't always performing loans, but lenders were making so much money on them.
Yeah.
Like they were factoring in some of those defaults.
Remember when we had the 228 with a 3-year prepay? I mean, some of these things that we had didn't even make sense.
Yeah, that was before my time. You said you got into the business in 1998. I got in April of 2007.
Oh, maybe I shouldn't have put a year in there.
That's a bad time.
Or maybe
that was a bad time to get into the business.
It was. It was.
But things are drastically different though. When you look back at that day, I mean, originating at that time, 04, 5, and 6, there were no end users. I mean, a lot of the builders were in a frenzy. They were throwing up high-rise condos. They were building mega developments all over Florida and other states, California, with no real domino end user, somebody that was actually going to live and occupy the home. People were buying multiple properties, going, no income qualify.
Oh yeah, and the appraised values went through
the
roof.
just to flip them, that was when you had somebody that was buying 3 at a time, with no intent to ever move into the development, just to hold on to them for a year and rent them at a loss, and then hope to make 100, 150,000 when the market went up on a resale.
Right. Yep.
Yeah, that's those times are gone. So I do feel much better about our market today.
Yeah, I think that even with a lot of the non-QM products, it's like Stacy said, it's a different world than it was back then. I think the industry learned from their mistakes, right?
Absolutely.
We learn in failure, and I think it's much, and I think what I love about like specifically the type of products that you guys are offering is it is an opportunity to take a borrower who does have the financial means to buy that house, to be able to afford that payment, to find a creative way to get into it. Now, from our perspective, one of the things we're always talking to our LOs about is how do you go out into the field and have unique conversations with referral partners, right? So from the conventional side of it, I say all the time, like we've all got great products, right? We've all got, like you said, FHA, VA, USDA conventional. We've all got the same products. We pretty much all have the same rate, and we all close loans fast. Those are the minimum expectations to be a lender in this market right now. But I want to help loan officers go out there and have different conversations, because if you're sitting down with a referral partner and that's what you're leading with, that's the same thing that 8 people before you led with.
Yep.
So if we can sit down and have some conversations that are more unique, and I've said this here before, I feel that if you're not working with a loan originator who has access to tools and resources like this, as an agent, you're closing less homes.
Absolutely.
Than you could be.
Absolutely.
Yep.
Yeah, we did a statistic. It was actually pretty interesting where we were saying for realtors, if they closed 1 extra loan or 2 extra non-QM loans a year that they didn't originally know that they could get financing for, they could get an extra $25,000, $30,000 in their pocket. I mean, that could put you, somebody's making $70,000, that could put you into the 6-figure digit.
Yep.
I mean, just a couple extra loans that you may have not even known you had the ability to offer financing for. Now you have that outlet. I mean, it's just, everybody wants to make money. That's what we're all in this business for.
Yeah.
So to be able to close those extra deals is phenomenal.
And so in your role as the account executive, you do a great job of bringing that information out to our referral realtor partners on presentations. So just explain that, you as an account executive, you don't actually do the loan, but you partner with us where we originate the loan, and then it's your loan product.
Correct.
That we broker and close with.
Yeah, so realtors and borrowers will be reaching out to you guys and, going over the scenario, and that's when you and I or your LOs and myself are going to be trying to, again, fit that round peg in the square hole type deal. We're going to figure out the best product, the best rate for the client. We're going to, if it's a bank statement program, somebody that's self-employed that writes too much off, can't show their tax returns, we're going to go ahead and calculate that income up front for you, even on a TBD property. So your realtor's not going to waste time driving around looking at houses that are not within reach of the borrowers, or maybe they're saying, I can afford a $700,000. We're going to do that income calculation up front. You're going to send us the bank statements. We're going to calculate that income and say, okay, here's your income that you have to work with. Now you know what price range you can start looking for, which I think is a huge asset for you guys.
That's
and
a huge tool.
Partners.
Yeah, that TBD is a huge tool.
Yeah. And it's funny because the bank statement borrowers, they don't bulk at rate. I mean, they're like so glad to be able to get a loan because most of the time they have really good credit. They have money down because they do very well.
And really good accountants.
And very good accountants.
Yeah. Very, very good.
Very good accountants. So that way they can get into their home. We calculate the income. They don't bulk at rate because they're, they can either show all their income and pay Uncle Sam 30%, or they can pay me, 5-6%.
Yeah. Yeah.
So yeah, it's a great product.
Yeah. So I'm gonna throw you a curveball.
Oh boy. Here we go. I'm ready. Put me in, coach.
I love asking this question. What product is not currently in the market that this industry needs?
Jumbo Prime.
Jumbo Prime.
It's coming. It's coming. You've been hearing that for a little while. Week and a half.
Do you guys have anything along with what Bryan just said? Anything that you guys have talked about that the consumer?
As far as my wish list, I think we need an I-10 program.
Okay.
I know it's out there. I'm not 100% sure if it came back after COVID with some lenders, but I think for us, we have a lot of people that are living here that have had businesses here for years and years. Mm-hmm. We don't have that program yet. I would love to see the I-10 program, somebody with an I-10 number, be able to do that financing.
Yeah, I mean, I think it's come back to some degree, but it's still restrictive.
It's very restrictive. Same with foreign nationals.
Yeah, yeah. I think one of the, in terms of a paper mortgage, like the thing that we struggle with the most is verifying assets.
So you want an asset free?
I want to. Yeah.
You want a NIVA?
Yeah.
No income?
No, we'll do the income.
The old world savings days where you put 25-30% down for the self-employed borrower that had 700 plus credit. They didn't have to dig up tax returns to qualify. There was tons of income, a big stream, and now they're forced into somewhat of a higher rate than they were allowed to, or afforded back 10, 12 years ago.
Yeah.
I think they've been penalized the most from all the changes that have happened.
So the self-employed borrower.
Yeah, I mean, you go back to when that product rolled out in the late 70s. That was around for well over a decade before it got to where it got to. Then it just expanded beyond the 20%, 25% into 80-20 and got crazy.
Right.
But that initial product, that alone, is I think what's still missing.
Yeah. I'm not saying not to verify assets. I'm saying, let's just work off a VOD. Instead of having to chase all of this money around, because that's what I feel like we're typically doing on the asset verification side. Just boom, let's order a VOD from your financial institution, and you've got the money.
The money's the money.
The money's the money. We don't care how it got there. Whether
that might be the money laundering thing that
they're
looking at. Yeah, they're looking to track some of that. Who brought that money into the bank, Bryan?
I don't know.
And you don't want to know.
No, I don't want to know. I just think it would make lending so much easier if we. Now in this case, I mean, you guys are using assets to determine income, but if we were going to prove the income, why then have to verify the assets?
Now, we only season our assets for 30 days. So we only need 1 month of a bank statement, which I think is good, because even if it is mattress money or a gift.
Yeah.
Can I not say mattress
you can
money?
Say, of course you can.
Is that a bad word?
No.
Even if it is money that they can't verify, it's a gift. They don't trust banks. It was mattress money.
Yes.
They put it in the bank at season. We still get going with we're processing their loan. We're moving forward. And right at the very end, you supply me with that 30-day bank statement.
Yep.
So no, it's not a VOD that easy, but I still think it's pretty easy.
That's still pretty easy. That's easier than
Chasing
the roads we have to go down. I think the other one is I mean, there's some out there, but 100% program for a I don't, for the life of me, understand why.
I think he started way before 07.
Yeah,
he was like late 90s. I think that's.
I'm just saying. Listen, we know VA.
We went down that
I know,
road,
but we
Bryan.
know VA loans perform.
Yes.
Right. We know VA and USDA loans perform. There should be, and maybe it's restrictive, like, hey, you have to be a first-time home buyer. You've got to have a specific credit score. Maybe you've got to have, I was going to say reserves, but you wouldn't need a 100% loan for that. But I just think that there's scenarios where a 100% loan would be beneficial.
I wouldn't be surprised if we see the 95 back, but I'm not sure we'll see the 100% back. just because we've been down that road.
Okay. Okay.
Because they got no skin in the game. So what's to say they wouldn't just up and leave, hence
Like
the
a lot
crash.
of people did, yeah.
Right, hence the crash.
Hey, let's switch gears, talk about investors. They've got a great investor program. So the investor cash flow, how does that work? And the LTV on that, and then the new rollout of 70% or lower, the debt service doesn't necessarily, it doesn't come into play. Talk about it.
So like Bryan was saying, a great way for your LOs to get into a real estate office is offering something that the other 6 people before you didn't offer. And I find that we call it the investor cash flow. A lot of people know it as the DSCR, debt service coverage ratio loan, where it's not based off the borrower's income. It's based off the cash flow of the property. This is a huge, for me, I believe it's a great way to get into a real estate office because 99%
realtors qualify.
Realtors want that loan for themselves. They don't show any income. They don't show any employment. It's just based off the market rent that comes back on the appraisal. If your market rent covers your mortgage payment, your new mortgage payment, that's all that matters.
It just needs to break even.
Just needs to break even.
Do you have to currently own a primary residence?
You do have to own a primary because it can't look like they're going to be potentially moving into it because Dodd-Frank would have our hide if we did a
it would look like occupancy fraud.
Loan. Yep. On a primary. So yes, you do have to own a primary residence, but you don't have to have any investment experience. Yeah, which is huge.
And what's the LTV?
A lot of people are trying to get. So we go up to 80% on that. So 20% down. You don't show any income. You don't show any employment. Just based off. And if you're getting into investing, you are looking for loans or houses that your rent is going to cover your mortgage payment, right?
Yep.
So, but we actually also offer, if you put 30% down and have at least a 700 score, we don't even care if it covers. So the market rent doesn't even have to cover your mortgage payment if you've got that much skin in the game. So
nice. So if somebody
too.
went and applied for the 80% and the rent wasn't covered, would you counter the offer back?
Absolutely.
Okay. So they can still move forward if they have the additional 10%.
Yeah, I think it's a great product. And for the lender, with the 70% loan to value, that's a lot of skin in the game, going back to your point, where if the loan went delinquent or went default, in today's environment where we're seeing record home appreciation, you guys are covered.
Right.
Like if you have to go back and...
Which is why we can offer that.
Yeah.
And right now they're saying people are wanting to invest right now as prices are going up. They're trying to buy investment properties because even if financial advisors are telling them keep it in the market, come out and get a loan. We have asset-based programs as well that it's just based off the assets that are in your bank. And they're saying, money's cheap right now. Money is very cheap.
That's a great point.
So, keep your money in the stock market because those are, that's doing really well for a lot of people.
Yeah.
So that's a great.
You mentioned rates being 4s and 5s. That's still phenomenal. I have a couple rental properties going back, back in the day that are still 5, 5.5, 6%.
We're even as low as 3s on our bank statement program.
Wow.
Yeah.
Very cool.
Yeah, that's great. I mean, we've talked about it before. I mean, right now with the low rate environment, and it doesn't matter whether you're prime or, non-QM, the smart thing to do is to put the least amount down as possible and keep your assets available for whatever you might need them for.
Absolutely.
So yeah, leverage.
Keep them in the market.
So tell you rolled out, I think it was just before COVID hit, the 1099. What?
Yes.
Explain how that works. Why one would go that route versus bank statement program.
So on the bank statement program, obviously you have to be self-employed or 1099 for at least 2 years. The 1099 program, we will require you to be 1099 with the same company for 2 years. So if you're with the same company, for example, Van Dyke, and they happen to be 1099'd, we could just take the 1099s instead of getting the 12 or 24 months of bank statements.
Okay.
So it's just a little bit easier.
Yeah.
There's no difference in rate or loan to value. The other reason why you might use it is on the personal bank statements. If they just have personal bank statements, which most 1099 borrowers don't have a business bank statement, anybody on the personal bank statements has to be on the loan. So if there's a spouse on there, maybe they don't qualify, and we don't want to put them on the loan, then give me your 2 years of
Oh,
1099s.
So let's just take a real estate agent that's looking
That's
to
what I
buy
was gonna say.
looking to buy a home, right?
Yep.
They've worked 5 years for a Keller Williams office, and they show 2 years 1099. What's the typical expense on a realtor? How would you guys use the
Right now, we're doing a minimum of a 30% expense. So we're going
Okay.
to average your 1099 bottom line over either 12 or 24 months. So either the 1 year 1099 or 2 years of
2 years.
1099. And then we're going
Okay.
to take a 30% expense.
All right, so somebody that gives you it's 100,000 1099 2 years in a row, you're gonna qualify them on 70,000 in income,
Correct.
and they can move forward and buy a home. Okay,
Yep.
good to know. That's
Yeah.
that's an awesome program.
Yeah, that is an awesome program.
Because a lot of realtors will have, they've got mileage, they've got tons of expenses, that they're
Well, I
probably
think-
adjusted down below that.
Right.
Yeah, I mean, listen,
in
I
many
think
cases.
anybody who is 1099 for the most part, the way that they're going to file their tax returns is going to be the best tax benefit for them.
Sure.
So, in this case, they're probably going to be able to get more income out of that 1099 program than we would averaging 2 years of, tax returns even on an S corp if they did it that way.
Yep.
So it's smart. It's smart because it's allowing people to still, relieve themselves of some tax burden and be able to get, into a home. You guys service your loans?
We don't. We
Okay.
sell off the servicing.
Okay.
We retain them, but we sell the servicing off.
Okay. All right.
Talk about the products that you have, the agency stuff that you do for like a near miss. Somebody that wants to go conventional or FHA, VA, not necessarily self-employed, but they've got 2 years verifiable income, but they've got credit, maybe a credit ding or a prior history with credit that prevents them from getting a conventional loan. What type of stuff can you guys offer?
We have loans for somebody that's 2 years out of a bankruptcy, foreclosure, or short sale. And if they did a Chapter 13 bankruptcy, we'll go off the file date. So if the file date's 2 years ago, but they just discharged maybe last month, that's okay. And the other great thing about the Chapter 13 bankruptcy, too, is if they included a mortgage in there, if they included a mortgage in their bankruptcy, and let's say the bankruptcy is done, whether it was a 7 or a 13, I should say, but the lender bank didn't take our borrower off title yet, so it looks like they just had a foreclosure or short
Yep.
sale.
Okay.
We're not going to hold that against the borrower. It's not
Wow.
their fault that the bank,
yeah.
neglected to take them off title. So we're going to actually use the discharge date of the bankruptcy for that quote unquote foreclosure as well.
Yeah, that's great. Listen, I think things happen. There are life events that put us in a situation where that's your only option, right?
Absolutely.
Bankruptcy or foreclosure, and those could be illnesses, those could be divorce. There's a number of things that could lead to that. And a lot of times there are things that are outside of somebody's control that have no bearing on what their creditworthiness was
Absolutely.
prior to that. Do you know what I'm saying?
COVID was a pretty big one.
Yeah, COVID was a
Very
pretty
big
big
one.
one. So, I think that's a smart product too, because I think I'm not knowing what all your qualification guidelines are for that, but I'm assuming they have to have showed some semblance of rebuilding.
Reestablished, yeah.
They've reestablished. Hey, I'm earning income, I'm paying my bills, whatever it may be.
I'm paying my
but,
rent.
We see all the time, by the way, people who have gone through a foreclosure or a bankruptcy who have very high credit scores that we can't do anything with until that term.
The time period. The cool thing about
Right.
it is if, let's say, we've got 2.5 years on our end to wait on a conventional product, they might qualify now with you, and your loans on a primary, there's no prepay penalty.
Correct.
So that's huge.
Yep.
I mean, so somebody that might still only be a year out from that event, they can come, not wait a year, right?
Yep.
Not wait for prices to go up another 10, 15%.
Yeah.
Potentially, right?
Yeah.
Get the loan with you, the rate's slightly higher based on that situation, and then turn it back to us, when that time expires, and they can get a regular product.
Yeah. Cool stuff. Anything else you guys want to chat about?
I think you want the Nina back, the CISA, and the Noni, everything, right?
The Santa Maria. What were they again? The Nina, the Pinta, and the Santa Maria. Yeah, let's get a couple of those loans going.
Wow.
Sail off into your sunset, Bryan.
It kind of makes you chuckle because you can tell when people get into our business in like the early 2000s. Because they went 5 or 6 years without actually collecting a tax return. They were just so used to that type of loan. Back in the day.
Well, listen, I think you've got loan originators in the business today that still remember that time, that don't want to accept that it's a different time, right? And they still have a hard time. Like, they're afraid that if they go to a borrower and ask for some bank statements, some tax returns, and some W-2s, they're going to be like, nope, I'm out. We're not getting that loan. I
don't want it.
Somebody else is going to give me that loan and not going to ask for all that stuff.
Right.
That's what
they'll piecemeal it though. What they'll do is they'll tell them they're approved and then slowly extrapolate the information over a 30-day period.
That's more painful to me than like hey,
root canal with no Novocaine.
Yes, there you go. Let's get it all up front. Yeah, listen, so, I'm trying to, give you guys solid ideas for loan products. I appreciate that. I'm going to write that down. I do what I can.
Take that back to the
for the
great
tip. For the good of the industry, for the good of the industry. So,
yeah.
Well, listen,
sure to let them know.
Stacy, thanks for spending some time with us today. I think we had a little bit of fun. We got a couple laughs in anyway. But thanks for sharing your wealth of knowledge with us and, really showing us how real estate agents and loan officers alike can create some opportunities for some folks who might not be able to get a mortgage through the conventional ways, and allow us to have some unique conversations that other folks aren't having. So I just want to thank all our listeners and viewers for tuning in with us today here on the Context to Contracts podcast. On behalf of John Jones and Stacy Flanigan, we just want you to know if there's anything that you need, we're always here to serve.